So those are some of the key issues right now facing the global economy. Let's talk a little bit more about trade and investment, because there have been some very interesting developments in this sector in recent months and over the longer term as well. Now, you've seen that chart if you've seen my presentations before, and I started saying it a few years ago, and it's held true. Global trade levels remain pretty depressed. Now, if you looked at this chart going back to the 1980s, global trade always was growing faster than the global economy. But really, since 2012, that's not the case. We've had almost no growth in global trade. There's a number of reasons for that. Companies are investing closer to home. They're starting to source closer to home. But we've also seen commodity prices down. We've seen risk levels rise. So we've seen this decline in trade. And you see it, and that's by decade, the chart on the bottom. And there's a clear decline in recent years in terms of the average rate of growth for global trade. So what are some of the key issues we're going to talk about? Of course, the threat of a trade war, which I want to talk a little bit more about later. It's not just China that's being targeted by the Trump administration. We have trade imbalances with some countries in Europe. We have trade imbalances with some other emerging markets. The Trump administration is focused, rightly or wrongly, on deficits that we have. Now, keep in mind, since this whole trade spat with China has started, our trade deficit with China has increased. So if the Trump administration's goal was to reduce the trade deficit, it's not working. What's happening is that if, let's say, the U.S. and China do escalate this trade war, which I'll mention in a little bit, China is going to try and export its products somewhere. It has to, especially with the domestic market weakening right now in China. So it's going to basically dump products in other markets, which is going to force them to start putting up barriers. The big danger of this isn't that it's just a U.S. and China trade war. It's one that spreads to many other economies around the world. If China starts trying to export cheaply to Europe, they're going to put up barriers. If they try to do it in Latin America, the same thing. So the proliferation of trade barriers is the real risk from this trade dispute. So a lot of the tensions that we have now in trade and investment stem from the fact that so much trade, so much export is now coming from emerging markets, so much investment is going to emerging markets. And you can see in developed economies the same picture. We've gone from 70% of exports in the world came from developed countries 20 years ago to just above 50% today. So a significant decline in exports from developed economies, and that's to be expected. But still, the imports, so as a market, developed economies still remain important, still about almost 57%. So we have that 7% imbalance where the exports have left, but imports are still coming into the region at a higher level. That's leading to these trade imbalances we see, not just in the United States, but in many rich countries. And then you see emerging markets went from 30% to almost 50% today, mostly in manufacturing. This is goods plus services, so if this was just a manufacturing chart, it would be significantly higher. But yes, they're becoming more important markets, but their importance has not matched the importance of them as exporting centers. So again, that's leading to a higher level of trade imbalance. China, of course, is now the largest exporter in the world. It passed the U.S. a few years ago. Its growth is continuing. The perfect example is the automotive industry. In 1990, China produced 500,000 cars. That's it. Today, it produces 30 million cars. It produces more cars than the United States, Japan, Germany, and South Korea combined. In one generation, it went from a nobody in the automotive industry to the dominant player. And most of that production right now is for domestic consumption. But last year was the first year in recent memory that automotive sales in China declined. So you have all this production, all this capacity in the automotive industry in China, and suddenly you have a market that's not growing. So what's going to happen? They're going to have to start to look to export. Now, most people right now probably don't envision themselves buying a Chinese car, but my father never, or my grandfather never would have envisioned buying a Japanese car. My father would have never envisioned buying a South Korean car. Everybody buys them now. So this is something that's coming for the automotive industry, and that is replicated in many other industries around the world. In China. Now, this is an interesting chart because it shows growth rates by exporters. And of course, China and India are right near the top of the list. But what's interesting for me is that among developed economies, the United States has still managed, despite a strong dollar, despite some weak export markets, to grow by 20% our exports over the past 10 years. Every other major rich country in the world has seen export growth, seen exports decline over the last years, except the United States. Again, that has a lot to do with the fact that we are very strong in very many high-tech, high-growth sectors. We still are the largest market for exporters in the world. The United States remains the #1 market, so when the United States sneezes, the world still catches a cold. China is catching up to us, of course. Their growth is faster, so it's just a matter of time till they do catch us. But nevertheless, the U.S. remains a significant market for exporters around the world. And again, in terms of growth, the U.S. we're still growing as a market. Again, in contrast to many of our developed country rivals, if you will, the United States remains a relatively strong market for exporters around the world. Of course, the growth is coming from places like China, India, Mexico. That's to be expected, China becoming an ever more important market. So this slowdown that we've seen in China is having a significant impact on many U.S.-based exporters. There were some trade deals reached over the past year. Of course, the USMCA replaced NAFTA. It sounds like a Village People song, but it's the new, and Trump was really sticking it to Canada because Canada was refusing to sign on until the end, so they got stuck at the end. That's hence the USMCA. There are not too many, most of the changes are cosmetic unless you're in the oil industry or the dairy industry, not the oil industry, the automotive industry. The automotive industry is one that could have there could be a major impact because part of the New Deal says that a certain share, I think it's 85% of a car's parts, have to be produced in factories where the average wage, I believe, is over $15, which is much higher than the average wage in a Mexican factory. So that could have an impact on the Mexican automotive industry, which has been doing very well in recent years. Another one is the CPTPP. These are hard to say. That's the former TPP that President Trump pulled the U.S. out of right after he took office. The other 11 countries went ahead and signed a deal to form a trade deal. So you have Japan, you have Mexico, you have Canada, Australia, and a number of other Pacific Rim countries forming what is, in many ways, a trade deal seen as a way to offset China's growing economic influence in the Pacific Rim region. There was a trade deal in Africa, including 49 countries last year, and the EU and Japan signed a bilateral trade agreement last year. So the developments, I'll talk about US-China in a second. Brexit, of course, Britain is a key export market, a key trading partner for the United States. We do not know what the relationship between Britain and the EU is going to be. Now, there was talk of Britain and the US signing a trade deal as soon as Britain left the EU. That doesn't look likely now because it looks like Britain is going to either, this process is going to be dragged out or Britain's going to remain in some sort of custom union. They're not going to be able to sign trade deals with other countries independently for some time in the future. I won't talk too much. The World Trade Organization, the Trump administration has been trying to weaken it. That's been a policy of the US now for some time. And then we put sanctions back on Iran. That's had an impact on the oil and gas industry because Iran, of course, is a significant exporter of oil and gas to Asia. And yeah. So the US-China trade war, what's going on? As you know, last year we put tariffs on $250 billion worth of imports from China. China retaliated. They put imports on $110 worth of US imports. We then threatened to escalate this trade war even further. But in December at the G20 summit in Argentina, President Trump and President Xi met, and they reached an agreement to have a 3-month truce. That truce says we won't raise that 10% tariff on the $250 billion to 25%, at least until March. And China will import more soybeans from the US, which is important here in Ohio, of course, and will reduce the automotive tariffs that they had put in place. Now, this truce runs out in early March. And it's very hard to tell what the Trump administration is going to do next because you can read the news any day and you'll hear one Trump administration official saying he's not happy with the Chinese adherence to the terms of the agreement, and then you can see the president tweeting the next morning that he's very happy with the way things are developing. So it's very hard to see right now what's going to happen in March. There is a possibility that we raise tariffs from 10% to 25% on those $250 billion worth of imports, and that we impose tariffs on the rest, the $267 billion of imports that haven't been touched yet. So this remains to be seen. We're only 6 weeks away from the deadline, 5 weeks now away from the deadline, and that's going to have a huge impact on the global economy depending upon how that plays out. And of course, China, as I mentioned, very important, is not, of course, as an export center, but increasingly important as a market for U.S. goods and services. So who's at risk if, let's say, this trade war does resume, and let's say it spreads to other countries, which would be almost inevitable if this becomes a full-blown trade war and we've imposed tariffs on all of their imports. That chart there shows a country's dependency on exports for growth. So it's exports divided by GDP, very simple. And you see countries like Germany, South Korea, Mexico, Canada, exporting countries, they would be hit extremely hard by any major disruption to global trade. Now, why does the Trump administration act like it's in a position of strength when it comes to these trade disputes? Well, that chart shows exactly why. Because the United States generates less of its economic output from exports than any other large economy in the world. Everybody suffers in a trade war to some degree, and certainly some sectors would suffer much more than others, like the soybean sector. But as a whole, the U.S. economy is better protected against a trade war than just about any other major economy in the world. So trade has been depressed in recent years. We're seeing developments. We're seeing countries trying to boost trade by reaching trade agreements. We see others trying to protect domestic industries by putting up barriers. It's not just trade where protectionism is having an impact and where this lack of confidence is having an impact. It's also on foreign investment, and here it's even more pronounced. In fact, with the exception of 2015, which was a special year, there was a lot of merger and acquisition activity that year, foreign investment levels have been falling steadily now for about 7 years. This, for me, says there's a real lack of confidence. You can look at confidence indicators all you want, but for me, the best measure of business and investor confidence is foreign investment. If companies are confident, they're going to take risks overseas, they're going to try and find new markets. When they're not confident, they're going to circle the wagons and protect themselves. And that's what's been happening in recent years. Almost no growth in foreign investment this decade. So again, I mentioned this lack of confidence. That's playing a key role. Their barriers aren't just being put in place on trade. We also have barriers on investment. We're seeing an increasing number of countries starting to protect what they call strategic industries. We saw that with Foxconn last year. We see a lot of countries now worried about Chinese investment, with Huawei, for example, with the 5G networks that are being proposed. And that's had a major role. China is, of course, a major source of foreign investment today. Its level of foreign investment in North America and Europe fell dramatically last year due to a lot of these barriers, formal and informal barriers. Monetary policy changes. One of the things that hurt emerging markets wasn't just the fall in commodity prices. It was the fact that we're raising interest rates here in the United States, that we cut back on the flow of available investments in recent years. That's having a major impact, bringing money back to the United States and other safe haven countries and out of a lot of these emerging markets. So again, if you look here, we are by far the largest recipient of foreign investment in the world here in the United States. That's the last 5 years of available data. The 2018 data is just coming out now. But over that 5-year period, the United States is by far the most attractive market for foreign investors. An interesting note is that 8 of the 11 largest recipients of foreign investors are or were parts of the British Empire, which probably has something to do with the business governance systems that were put in place by the British and that have been followed by former British colonies ever since. We also are the largest source of foreign investment, which is to be expected, of course, as the largest economy. But what's interesting here is that a lot of the major sources of foreign investment are these slow-growing, old world, if you will, economies. Now remember, back in the 1980s, Japanese companies started investing heavily in the United States, even though at the time the Japanese economy was growing at 6, 7, 8% per year. Well, why was that? It was because the smart Japanese businessmen knew that that situation couldn't last. The demographic situation was dire. The financial system in that country was in dire straits as well. So they started going to markets where they thought they would grow. We're starting to see countries like France, Germany, Netherlands, other European countries now doing the same thing. They know that growth prospects in Europe are limited. They're starting to invest where the growth is likely to be higher in the years ahead. As far as the United States trade, what's interesting there is we talk about how we're getting beat on trade all the time because we have deficits with a couple countries. But look at that. Our share of global exports until at least 2016 grew significantly. Again, part of that is the high-tech sectors we're in. We have a lot of commodities here that the world wants. We have a very robust agriculture sector. Agriculture is one of the safest growth markets long-term in the world. So we actually were doing pretty well. Now, we've seen a decline in recent years, but still the United States accounts for about 10% of global exports, a pretty substantial amount. Foreign investment growth in the U.S. is also slowed, just like in the rest of the world. It hasn't slowed as much as in others. We had that huge growth in 2015, but a lot of that is due to the new barriers that have gone in place in recent years. What about Ohio? We're here in Ohio. How is Ohio doing in terms of trade? The chart there shows our global trade growth. We had a little bit of a slump in 2015 and 2016, but we're forecasting higher trade growth over the near term. Of course, our trade markets are the three countries that were most targeted by the Trump administration for trade barriers. Canada, Mexico, and China account for about 60% of Ohio's exports. So that's a bit of a concern. But the fortunate thing is those are all markets that we expect to record at least decent growth in the years ahead. A lot of other U.S. states don't have such an interesting market profile for their exporters. In terms of foreign investment, again, it's relatively diversified here in Ohio. Of course, a lot of it is focused on industry, whether it be automotive, industrial machinery, plastics, metals, rubber, et cetera. But it is relatively diversified. We're not dependent upon any single sector for investment. And we're not dependent upon any single source of investment. No country accounts for more than 20% of the foreign investment coming into Ohio. That's favorable. We do this in other states, and you look at some of these charts, some states are reliant upon 40% of all foreign investment goes into one sector, or it comes from one market. So keeping the sources of investment diversified, as well as the sectors where the investment is going diversified, we view as a very important key to growth.